Imagine this. After years of building up your savings and investments, a recession hits and suddenly, the value of your portfolio drops. The market crashes, jobs disappear, and economic uncertainty sets in. It's a scary thought, right? Well, you're not alone. Millions of people face this reality during every economic downturn. But here's the good news. With the right strategies, you can not only protect your investments, but also come out stronger on the other side. In today's video, we'll cover the 5 must-know strategies to recession-proof your investments and your financial future. Stick with us till the end, where we'll reveal a crucial step that many investors overlook during a recession. You won't want to miss it because this one move can save your portfolio and set you up for future success. Before diving into strategies, let's take a moment to understand what a recession really is. A recession is a significant decline in economic activity across the economy, lasting more than a few months. You'll hear terms like GDP falling, unemployment rising, and stock market volatility. But what does that mean for you? It means job losses, lower consumer spending, and a stock market that could drop by 20%, 30%, or even more. For example, during the 2008 financial crisis, the US stock market lost over 50% of its value. Investors lost trillions of dollars. Recessions, while tough, are part of the economic cycle, and how you prepare for them will determine how you come out on the other side. In fact, over 22 million Americans lost their jobs during the 2020 pandemic-driven recession. Recessions create financial chaos, but they also present opportunities for those who are prepared. When fear takes over, people make rash decisions, and that's exactly what we want to avoid. One of the biggest mistakes people make during a recession is panic selling their investments. The stock market drops, fear spreads, and many investors rush to sell off their assets to cut their losses. This often leads to selling at the bottom of the market, locking in losses. The result? You lose the chance to benefit from the market's eventual recovery. Another common mistake is trying to time the market. During a recession, stock prices are volatile, and many investors believe they can sell at the right time and buy back in when prices are low. But here's the truth. Even professional investors struggle with market timing, and getting it wrong can cost you even more. Finally, some investors move all their money into cash or safe assets, thinking it will protect them. While having cash is important, especially for emergencies, putting everything in cash means you miss out on potential gains when the market rebounds. So, what's the solution? It's simple. Have a recession-proof plan. By following the 5 strategies I'm about to share, you'll be prepared to protect your investments and stay on track to achieving your long-term financial goals. Let's dive into the first one. Here are 5 must-know strategies to protect your investments during a recession. Strategy 1. Diversify your portfolio. You've probably heard the saying, "Don't put all your eggs in one basket," and when it comes to investing, this is critical. Diversification means spreading your investments across various asset classes: stocks, bonds, real estate, commodities like gold, and even international markets. The reason? When one asset class underperforms, another might perform well, helping to balance out your portfolio. A study by Vanguard found that a well-diversified portfolio historically performs better during recessions compared to one that's concentrated in a single asset class. For instance, in the 2008 recession, while the stock market dropped by more than 50%, bonds and gold rose, providing a cushion for diversified investors. So, how do you diversify? Consider including defensive stocks, bonds, real estate investment trusts, REITs, and commodities. This balance will protect you from extreme losses when one sector or asset class declines. Strategy 2. Increase your cash reserves. One of the most important steps you can take during a recession is to have cash reserves. Why? Because liquidity is king in uncertain times. Having an emergency fund with 3 to 6 months worth of living expenses is a must, but during a recession, it's wise to increase this reserve. Cash reserves allow you to maintain flexibility. If an opportunity arises, like buying stocks at a discount or covering unexpected expenses, you'll be ready. Think of cash as your financial safety net. During the 2020 pandemic, millions of people who had sufficient cash reserves were able to navigate job losses and economic uncertainty without going into debt. Make it a priority to build up cash reserves before a recession hits. You'll be in a much stronger position to weather the storm. Strategy 3. Invest in defensive stocks. Not all sectors are hit equally hard during a recession. While tech stocks and luxury goods may see massive declines, some industries known as defensive sectors remain stable or even grow. These sectors include healthcare, utilities, and consumer staples. People still need medication, electricity, and food regardless of the economic climate. Companies in these sectors often have steady cash flows and are less impacted by economic downturns. For example, during the 2008 recession, consumer staples like Procter & Gamble saw far less volatility compared to tech companies. Consider adding defensive stocks to your portfolio if you haven't already. They may not provide explosive growth, but their stability will help protect your wealth in tough times. Strategy 4. Avoid high-risk investments. During times of economic uncertainty, it can be tempting to chase high-risk, high-reward investments in hopes of quick profits. But the reality is, riskier assets, like speculative tech stocks or cryptocurrencies, are often the first to crash during a recession. Take the dot-com bubble of the early 2000s, for example. Tech stocks were the hot investments at the time, but when the bubble burst, many of these companies lost up to 90% of their value. The same happened with cryptocurrencies in the recent 2022 crash, where Bitcoin dropped over 50% in just a few months. Instead of chasing speculative gains, focus on safer, more stable investments. While the potential for return may not be as high, you'll be protecting yourself from catastrophic losses. Strategy 5. Keep a long-term perspective. Recessions are a natural part of the economic cycle. Historically, markets have always rebounded from downturns, and those who stayed invested through the tough times have often seen significant gains when the market recovered. For instance, after the 2008 financial crisis, the stock market bounced back and grew by over 400% in the following decade. Those who panicked and sold their investments during the downturn missed out on this massive recovery. The key here is patience. Don't be swayed by short-term market movements. If you've invested in solid companies and a diversified portfolio, staying the course will likely benefit you in the long run. Now that we've covered how to protect your investments, here are a few additional tips to boost your financial stability during a recession. First, focus on cutting unnecessary expenses. While this might seem obvious, the reality is that many people continue spending on non-essentials during tough times, which leaves them in a worse financial position. Second, work on paying down high-interest debt. Credit card debt, in particular, can eat away at your cash reserves and savings, especially during a recession. By paying off debt, you free up more of your income to go toward your investments or savings. Lastly, increase your emergency fund if you can. Having 3 to 6 months worth of expenses is great, but during a recession it's wise to aim for 9 to 12 months of expenses. This gives you the flexibility to cover unexpected costs or ride out a job loss without going into debt. Let's quickly recap the 5 must-know strategies to protect your investments during a recession. 1. Diversify your portfolio to reduce risk. 2. Increase your cash reserves for financial flexibility. 3. Invest in defensive stocks that perform well during economic downturns. 4. Avoid high-risk investments that could lead to significant losses. 5. Keep a long-term perspective to benefit from market recoveries. By following these strategies, you'll be well-positioned to protect your investments and grow your wealth, even in the toughest economic times. If you found these strategies helpful, don't forget to hit the subscribe button, like this video, and share it with others who could benefit. We'll continue sharing more insights and tips to help you protect your financial future, no matter what the economy throws your way. Thanks for watching, and we'll see you in the next video. Thanks for